Good noon to everyone. This is Dr. D. Kurtika, Department of Commerce with Computer Application, Dr. S.N.S. Rajalakshmi College of Arts and Science. A warm welcome to my YouTube channel, Learn to Win. Today we are going to discuss about the interesting topic of residential status of an company and its relation with the tax in the series of your corporate tax. So to understand what is the residential status of your company, say it is crucial in determining its tax obligations in any country, but like in India, the residential status of a company affects how it is taxed under the Income Tax Act 1961. So we have an overview of the residential status of the companies and its implication for taxation in India. So in India, the company's residential status is determined based on the criteria specified under the Income Tax Act 1961, and it is classified as resident or a non-resident. So resident of a company is considered like it is incorporated in India, it is not incorporated in India, but it is control and management are situated wholly or partly in India during the relevant previous year. I think you are able to understand the terms of your previous year and your assessment year. That is, the assessment year is the current year. Say for example, in this year, the 2024 to 25 is our assessment year. It starts with 1st April 2024 and ends with 31st March 2025. So the financial year is the year preceding the assessment year. So immediate preceding to your assessment year for this particular year, that is 2024 to 25, is 2023 to 24. So for the assessment year 2024 to 25 for the current year, our relevant previous year will be 2023 to 24. Okay, so the residential status of a company is considered in India if it is incorporated in India, or if it is not incorporated in India but its control and management are situated or wholly partly in India during the relevant previous year. Because we are considering the previous year, the reason is the previous year, only in the previous financial year, the income will be earned. Only the earned income will be taxed. Therefore, the financial year, that is the relevant financial year, will be considered. Then the control and the management, this generally means that the key decision making process of the company, including the strategic and policy decisions, are conducted in India. This includes the meetings of the board of the directors and other crucial management activities. Then non-resident of the company, that is, a company is classified as a non-resident if it is incorporated outside India. So it's very clear that the control management, it can be outside India, but it has to be incorporated in India to be a resident. So its control and management are situated in India during the relevant previous year. Implications for the taxation is the residential status of a company directly influences its tax liabilities. Therefore, the resident company, that is global income taxed. When a resident company in India is taxed on its global income, this means that it must pay the tax on all income earned. As discussed earlier, only for the income earned we are going to pay the tax. Therefore, this means that it is pay the tax on all income earned, whether it is generated within India or outside the country. And again, the resident companies must compute their income according to the provisions of the Income Tax Act, including various deductions, exemptions and adjustments allowed under the Act. The tax rates, the resident companies are subject to corporate tax rates specified in the Income Tax Act, which may vary based on the nature of the income and the company size. So the company size, it may be the large, small, medium. So according to their size and the nature of the income, this tax rates, it may vary in the Income Tax Act 1961 for the resident company. Same way for the non-resident company, a non-resident company is taxed only on the income that has a source in India. This includes income from operations, property, investment or any other business activities conducted within India. So this income computation for this non-resident company is subject to the tax on income earned from Indian sources, and the tax is usually levied at higher rate compared to the resident companies. We have to keep one thing in our mind. In India, we are considering the progressive tax system. So the higher the income earned, higher will be the tax paid. Lower the income earned, the lower will be the tax paid. Same way, tax treaty benefits. India has entered into double taxation avoidance agreements. In short, we say them as DTAs with various countries. So these treaties can influence the tax rates and the nature of the income taxable in India for non-resident companies. So the companies can claim benefit under these treaties to avoid the double taxation. And again, for the transfer pricing, both resident as well as non-resident companies engaging in the international transactions must comply with this transfer price regulations, ensuring that the transactions are conducted at the arm's length and appropriate documentation is maintained. For everything, the documentation should be properly maintained. So according to our IRS also, we are supposed to maintain all the documentation, and it has to be properly audited and verified yearly once. So this is regarding your resident and non-resident companies. And compliance and reporting filing requirements, that is both resident and non-resident companies must file their income tax returns annually. Resident companies do need to provide details of their global income, while non-resident companies must report income derived from Indian sources. And then tax audits. Resident companies and non-resident companies with significant operations in India may be subject to tax audits to ensure compliance with tax laws and regulations. So to conclude, the residential status of a company determines its tax liabilities and obligations in India. Resident companies are taxed to their worldwide income, while non-resident companies are taxed only on the income sourced from India. The residential status affects the computation of tax, the application of tax rates, and eligibility for treaty benefits. Understanding and correctly determining the residential status is essential for accurate tax compliance and reporting. So I think you have a clear picture of what is the residential status of a company under the two categories. One is your resident and your non-resident. Keep on watching my channel for your updation regarding your corporate tax. Thank you.